Okay, so in this video, I'm going to talk about the cost of preferred stock. So if you're looking at preferred stock, basically, if you go back to valuing a share of preferred stock or valuing a stock with no growth in the dividends, then basically, if I'm valuing a stock with no growth in the dividends, then basically what I would do is I take the dividend and I would divide it by the required rate of return. And that's basically what a preferred stock is. It's a stock that pays dividends that have no growth. So if that's the case, the expected price of the stock would be the dividend divided by the required return of the preferred. Well, if I just rearrange that, what I get is the required return on the preferred should just be the dividend divided by the price. Well, I can look up the price, and if it's got a dividend with no growth, then I should be able to look up the dividend. And so if I put those together, I should be able to calculate the required rate of return on preferred. Now, the little catch here is if I'm looking at the marginal cost of preferred stock, in order to get an extra dollar of preferred stock, I would actually have to issue preferred stock. And if I have to issue it, then I'm probably working with investment banks and they are charging me fees, which means I now have flotation costs. So in order to modify that, what we would do is basically show that I'm going to have the dividend, but I'm going to divide it by the price times this 1 minus F. F is the percentage flotation cost. So let's suppose I'm looking at a stock, and let's suppose the current stock price for the preferred stock is $30, and the flotation costs are going to be 10%. Well, I'm going to take 1 minus 0.1, so that's going to be 0.9. 0.9 times the $30, going to be 90% of the $30, which basically means it's going to be $27. So I would take the dividend divided by the $27. Now, let's talk about what this means. Basically, what this means is when the shareholder or preferred shareholder buys a share of stock and pays $30, they are expecting a dividend relative to that $30, and they're expecting a particular return. But the company doesn't get the full $30 because the investment bank takes a piece, right? And so what we're calculating here is we're figuring out, well, we got to subtract out how much the investment bank took and figure out what rate of return the company needs to earn to keep the preferred shareholders happy based on what the company actually received from this transaction. So that's why we took the $30 that the stock sold for, but we multiplied it by the 1 minus F to reflect, all right, so the shareholder or the new shareholder, the person who bought the stock paid 30, but the company did not get 30, the company got less. And so basically we are kind of shrinking the amount that the company received. And the effect of that is if we shrink the denominator for a given numerator, that required rate of return gets higher. So basically what that means is the more the investment bank requires as a percentage in terms of flotation costs, the less money the company receives from selling the preferred stock. And therefore, they still have to earn the dividend that they're promising, but they have less money to invest to get it, which means the company has to earn a higher return to provide the return the shareholders are expecting. So ultimately, what that boils down to is if you're a company and you're selling stock, you want to try to minimize the flotation costs because that just eats up how much money you actually receive. But this would be one way I could calculate the required return for a dollar of preferred stock. Hopefully this helps. Thank you so much for watching and have a great day.